We're live. It's Tuesday, August 23rd. We're going to look at some mortgage rates today. Oh, yeah. We're doing the thing. Still not ideal conditions for me here. Another couple weeks like this. But there's no reason to not make content, you know. A lot of people in real estate space should be making more content right now. And not just like bullish content, but just discussions. And people attack me all the time. Attack me for being not totally bearish. You know, I'm pretty neutral on the market. I do think that it's an opportune time right now. That doesn't mean that I think prices are going to go higher right now. That just means that I think that it's an opportunity. We'll look back on this time and say, gosh, it was so obvious. What were we thinking? Rates went up, buyers scattered. That's when you buy. That's all I'm saying. That's all I'm saying. So we're going to look at mortgage rates today. We're going to do that first. So we're going to look at rates first, and then we're going to dive into something. Give you a little preview here. There's some stuff in here today. Let's see. What was the first one? So this one, team. And this is what I always talk about. This. Remember when I told you that we're going to see tons of negative articles, tons of negative headlines about home buying. 72% of recent home buyers have regrets about their purchases. I'm going to break this article down like a cardboard box. This is sinister, damn near. Should be criminal to publish things like this. This organization knows good and well how many people see this and what influence it makes. And to misrepresent what just even the survey they're discussing here is pretty disappointing. Look at the actual survey itself, the data in there, rental growth, big investment firms betting on that. I've been talking about that for a long time. We're in a housing recession. What does that mean? And then, of course, mortgage bonds. Let's start here. We'll go here. Then we're going to pull up specific rates. And I'm going to look at rates today because we've had sort of a bad run here. You know, this has not been a great few weeks. And this is a mortgage bond chart. So you look at this. So when you see mortgage bond prices going higher like this, that's rates going lower, right? So when bond prices go higher, rates go lower. When bond prices go down like here or down like here, that's the last few weeks right there. You know, we've lost 100 plus basis points. You know, that's when you see rates go up. And particularly the last few days, see here, we've got nothing but 1, 2, 3, 4, 5, 6 red candles in a row. Not hugely red, but we fell out of this beautiful channel, upward channel that we were in. We are now out of that, trying to find support. And hopefully we're going to find it here, you know, right in this area where we are right now, approximately. I expect that we will, but that means that rates could get a little bit worse here in the next couple of days. So let's keep that in mind as we're going to look at real-time rates today. I do expect to see lower rates by the end of the year. I tell you, we really got stung pretty hard. The stock market had a very bad close last week. It was a middle finger close. I could show that to you too, but we're not going to get in that today. We are live, by the way, on all these platforms, Facebook, Twitter. What's going on? C. Green Jr. Diamond Hands D is here. What's up in Temecula? Good to see you. Savage One. What's up, bro? Did recent modification. Can I still do cash out refinance or HELOC? You can. As long as your modification is completed, your forbearance or whatever is over with, you can still do refis, purchases, cash outs, etc. You just have to look at the program that you're doing. Sometimes things are a little bit different, but yeah, reach out to me, Juan, and I'll hook you up. Okay, so we're live. So if you want to drop comments, questions throughout, feel free to go ahead and do that. We're just going to kind of walk through. I'll get to all these articles, but those are not the timely information. Or sorry, all of this is really timely, I guess. But the interest rates, I think, is the big question that everyone has. And obviously the thing that most people are getting wrong. So we're going to look at VA, FHA, conventional, both conforming balance and high balance. And then we're going to look at jumbo. We're going to look at all those and just get a feel for where are interest rates right now. These are wholesale rates that we're pulling here. I'm a broker. You don't automatically qualify if you have the credit score. We're going to use a 780 credit score for everyone. So if you have a lower credit score, your rate could be lower. We're going to assume these are in San Diego. We're going to assume these are detached homes. Condos could have higher rates as well, so keep that in mind. And we're going to do no fees because that's the way we roll. We don't charge fees. People like that. This market is extremely competitive, as I expected it to be. So we're going to do VA conforming balance first. Got into an absolute knife fight today for one, but it's hard to beat us. It really is. So here we go. This is one of those interesting things where there's a bank, CMG Wholesale. Okay, now look at this. So CMG on this product here is 100 basis points better than the next one, Mutual of Omaha and the United Wholesale. 100 basis points better. This is why being a broker is the way to go. Now, CMG is not my favorite bank to use, but you can get things done quickly with them, and they are reasonable. They just are, the operations, they're not as quick on turn times and stuff like that. You can still do a 21-day close. We've done plenty of them, but you can't do that 14-day close with them. That's for sure. But look at this, 100 basis points. So right here, we're looking for CMG. You're looking at 4.5% and getting $2,500 on the $600,000 loan. And the next best one, you can see the APRs are disclosed right here in the same size. The next best one, Mutual of Omaha, and they're at 4.75 with 2,200. So you see a big difference there sometimes between banks, and that's why it's important to have options. So when you're buying a home and you're refinancing a home, if you're working with a bank, you're talking to someone who's a salesperson for that bank. When you work with the broker, you're talking to someone who's trying to find you the best deal. That's just a great example of that right there. Look at CMG trying to buy some market share, and sometimes just they'll be going after market share, and the whole purpose of them doing that is lowering their rates because they want to get brokers, they want people like me to send them clients, and they know we're not going to do it unless they sharpen their pencil. So that's the reason why they do stuff like that. And it could be a different bank today, a different bank tomorrow. We got options. I don't represent a bank, I represent you. So now let's do high balance. So high balance VA this time, that's above 647,200 loan amount, and United Wholesale here is the winner. So you could, it's different depending upon the both VA loans, right? Different loan amounts, different banks can have the best deal. That's where the broker advantage really is. Okay, so United Wholesale 4.875, small credit there, lender fees on any of this stuff. Small credit $337, 4.875. Not too shabby. Not too shabby. So I actually locked a high balance VA today perfectly. I would give a pat on my own back if I could. This morning when rates were better at 4.75, but they did get a little bit worse here later in the day. Okay, so 4.5 for conforming balance VA, 4.875 for the high balance. So a little bit of a delta there, and I think we're going to continue to see that as there's less and less conforming balance loans that are done. And remember, the government wants a balance between the two, and that's why they are always raising that threshold, 647,200. Now, I bet it's going to be way higher next year, because they want to see a balance between loans that are done at the lower threshold and the higher threshold. Now let's look at it. Let's look at FHA. For FHA, we're going to start with the high balance on this one. So let's see, 3%. So 21,000, 24, 25,000. Let's call it 675. Close enough. This is a detached home, 780 credit score. You do need to income qualify for these rates. You don't just get them with your credit score. So high balance, FHA, United Wholesale again, 4.875 is the rate. Let's look at the rate sheet. Yeah, and only a few bucks there. Let me see if I can make this bigger. There we go. And only a few bucks to go to 4.75. Not bad. FHA has been tracking slightly lower than VA. Of course, the VA is a far superior product from a loan standpoint, but not everyone can get a VA loan. Now let's check the conforming balance for FHA. And what's really cool about this market right now is I'm seeing lots of buyers getting closing costs, renegotiating, getting credits, all kinds of stuff. It's really a good opportunity for buyers, in my opinion. It's not, I wouldn't say it's a full-fledged buyer's market, but it's really close. It's really close to being an actual legitimate buyer's market where buyers are ruling the roost. And right now, and the best way you can check on that is always ask a realtor, would you rather have a buyer or a seller right now? If they say they'd rather have a buyer, it's a buyer's market. Okay, so CMG again on the conforming balance. So conforming balance govies right here. CMG's crushing everybody, crushing. And that is good to know. Very good to know. Ameris Bank is in the mix too. Mutual of Omaha, a new player in the game. But CMG definitely has their 4.5. So 4.5 to 4.875. That's what we're looking at right now for FHA, VA. Let's look at conventional rates. And mind you, when I look at conventional rates, we're going to look at 5% down. Rates will be better with like 20% down, 25% down. But we can only do so many scenarios. It's just there's only so much time, and we've got other things to get to here. So we're going to look at conforming balance first, and this is just minimum down payment, conventional loan, under 647,200 loan amount. What are the rates today? CIT, United Wholesale. So CIT is definitely a specialty type bank. I would not use them for a purchase loan unless we really had to. To get the same rate, United Wholesale, I would go that direction all day, twice on Sunday. 5.375. So 5.375 is the fixed rate right there. No points, no lender fees. Now let's check the high balance. And it's really interesting right now seeing some of the people who are just making offers are like, hey, we're only qualified for this. We're going to make an offer on this place. And they're getting counters. They're getting a discussion. I mean, if you're a buyer, that's exactly what you want to see. You absolutely want to see discussion from your offer, even if it is a quote unquote lowball offer. Okay, so high balance here, getting up to the 6% range again. We've got Mutual Omaha there. United Wholesale pretty much right in the same place. 5.996% seems to be the going rate here. I've got both for high balance, conventional, minimum down payment. You know what? For funsies, let's do this. Let's do a big down payment on this one. Let's do, let's see. We can't do 25% or let's do this. Let's do $1 million purchase price. Here's a real San Diego scenario for you that we see with conventional loans all the time. $1 million purchase price, 25% down. What does this look like? We just checked the minimum down payment on the high balance. We're at 5.99, 6% in that range for no points and no lender fees. What does it look like? That one's expired for that one. 5.625. It's there. 5.625 is there. So yeah, lower rate for more of a down payment there. And you'll see that a lot of times with conventional loans, the down payment amount really matters. It doesn't matter as much for FHA and VA. Yes, sir. We live. What's up, Michael? How you doing? Say what's up. We're just dropping straight truth bombs here. Incoming truth missiles. People love them. People hate them. Which side are you on? Let's do this too. Well, I'm going to transition over to articles. So that's just a quick look. Actually, you know what? No, we're going to do jumbo. Let's do jumbo. I have a jumbo scenario I like to peep. So let's do this one. I'm going to do $2 million purchase price. And we're going to do, let's see, 25% down. And let's see what options we have for jumbo fixed. And then we're going to do jumbo arm. And I actually have to take the fees in off because some of the jumbo banks don't populate unless you do it. So we'll pay attention to the credits and the lender fees on this because I had to take that. I'd uncheck that box. JMax smoking. 5.25 for the fixed rate on that jumbo. That is a smoking deal. We have a comp cap at JMac for that reason, so we can get you smoking, absolutely smoking jumbo rates. Now let's look at ARMs for the jumbo world. ARMs make a lot of sense. The ARMs really aren't making sense in conventional and government world yet, FHA, VA. But let's see about a 7-year ARM here, jumbo. Oh, come on, Lone Sifter. You've done so well. I'm always worried that this thing is going to crap its pants. Okay. CIT, yeah, they're really, really good for this. Jumbo ARM, look at that, 4.575. The lender fees are $1,000. So let's factor that in here. Let's look at the pricing. So yeah, so 4.575. You got 945 in credit, 1,080 in lender fees. So pretty much washes out 4.575 for a 7-year ARM on a jumbo right here in this market. How about that? That's a conforming FHA or VA rate on a jumbo. Pretty wild. But once you do that 25% or more down on the jumbo, you're able to get rates like that. Closed one recently for 4.2, which was a good deal. I knew it was a good deal. And one several months back for like 3.9 off of this program. And it is not a fun CT, but it's like doing a loan with a regular bank, except for you have the advocate of a broker on your behalf to to broker the conversation and keep everyone's heads cool. All right, so here's what we're gonna do. I gotta do this stuff. We got to talk about a couple of these articles today. And while I'm pulling that up, I'll do a quick. There it is. Just a quick plug. Got lots of time on my hands right now. Small pipeline, plenty of time. Market's low. Give me a shout. If you have a quote or something like that, you're not happy about a quote you got under. Let me just quote it for you. Let me just see if how bad is it. Is it pretty close and you just don't like it, or is it actually really bad? Multiple people in the past 5 days have reached out to me and said, "Hey, my buyer got a quote from their lender, and they're like really upset, and they think it's terrible. You just quickly take a look at it for them. Of course, call, text, email me. I'll get you a quote quickly. Make sure we take care of you. All right. So let's do this. Where is it? Okay. Let me show you something. I wish I had the buttons here, but I won't have those until I get back home. It just doesn't work. The internet here sucks. 72%. I mean, look at this. If you were a home buyer and you saw this headline, 72% of recent home buyers have regrets about their purchases. As the market cools, these steps can help you avoid disappointment. Wow. A lot of promises. Notice the very long headline. 72% of recent home buyers have regrets about their purchases. Well, first of all, I'll just go ahead and tell you, they surveyed 1,000 people. And we don't know where the 1,000 people were from, but 1,000 people. And when you say 72% of recent home buyers have regrets about their purchases, that's any type of regret whatsoever. Any type of regret whatsoever. Not overall regret the fact that they purchased a home. Not overall. But any type of regret whatsoever. Anything. We didn't like our lender. We didn't like our realtor. It turns out we wish we had a bigger yard, or just anything. We love the house, but we wish we had a bigger yard, or the closet's too small, or whatever. Any regret, it shows up on here. Okay. So first of all, it's extremely misleading. Second of all, they offer no valuable insight in this article, but I'll leave that for you to decide. So when you look at this, we'll get into it a little bit here, and then I'll post the link for you too. Number one reason for the buyer's remorse, 30% of respondents said they spent too much money. So this is going back 1,000 individuals who purchased a home in 2021 or 2022. Well, we're not all the way through 2022, so we're assuming the majority of these people were 2021 purchases. Listen, here's what I can tell you from personal experiences. I always follow up with people. People get gifts from me. I follow up with you to see how things are doing, to see if you're enjoying the home. Almost everyone that I follow up with, and I do this every single day, they are saying things like, yeah, we're stoked that, we have all this equity. I mean, that's what everyone says. They're like, yeah, we're so glad we bought when we did. Like, so the feedback that I'm getting, and maybe it's biased because people think I want to hear something positive. Apparently that's my position now, but people are loving it. They're like, yeah, we crushed our home purchase. We absolutely nailed it. And they're super stoked about it. So I haven't heard anyone be like, yeah, we don't like this. There's one person that I've had in the last year and a half who bought their home and then decided they didn't like the area and they wanted to sell it and buy something else. That's one instance, dozens and dozens of people. So I can't concur with this. 26% indicated they bought too quickly. That was the frenzy of the market. That's why I'm proud of the market that we have right here today. By the way, we're live on everything. Drop a comment if you want to say what's up. I'll give you a shout out back. For sure. What's up, Nathan? Derrick's the man. Get a quote, people. Make sure you're not getting ripped off, y'all. Come on now. So that people were buying too quickly. People were moving contingencies. I was telling you it was insane. Told you it was insane. But it was a mania. It felt like it was never going to end. It felt like that you had to do that or you would never be able to buy a home ever again. Now we're seeing people go back for third showings, fourth showings on these things before they'll write an offer. We're seeing buyers really take their time. We're seeing buyers really do due diligence. We're seeing buyers before they'll write an offer, having a contractor come out and look at something. Like, people taking their time right now in the market. Part of what's making the market slower, we're used to this frenzy. Now people are being more patient, being more prudent. This is good. not a bad thing. This is a good thing. Should take their time. It is a big purchase. I understand when you see the perfect home and you know there's multiple offers, wanting to do whatever it takes to get it. I do understand that. I have been there before. I've also canceled contracts after getting into them because of that. But people taking their time, this is a good thing. Okay. And you can learn that from this. This is the one thing to learn, I think, from this article. Online survey was conducted in July, included 1,000 individuals who bought a home in 2021 and 2022. It was commissioned by Anytime Estimate, which is owned by Clever Real Estate. So this is an important disclosure. Clever Real Estate, what is that? I'll let you look it up if you want to. But essentially, it's a real estate service provider. So they provide loans, real estate services, agent referrals. So it's essentially what this is, to boil it all down for you real quick, here's incoming truth missile. Hide your sensitive ears. This is an advertisement. Okay? That's what it is. This is an ad. Now, they don't have it listed as an ad. They don't have it they don't have it sponsored on here. And they can get away with that because of the editorial look of this thing. But this is a clickbait headline that's pointing people to Clever Real Estate. And I'm going to actually give you a link. I'm going to point you to them too. You can read more information about this survey on here, which appears to be something that they have done with the idea that they could get eyeballs to their website, get clicks, and ultimately, push people towards, real estate referrals and so forth. Find an agent, mortgages and loans, calculators, blah, 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 all the stuff they have up here. So that's what's really going on here. So when I say be careful about what you consume, don't trust, there is always something going on behind the scenes with these clickbaity headlines, always. And that is exactly what it is here. And I've done the research for you, but I'll give you the links. You can go look at it yourself, and you can argue with me if you want, but you'll be wrong. Rent growth for who else has been telling you that? Who else? What's up, Greg? Is Blackstone still buying up homes? Well, they just had of course they are. They've been steadily buying homes since 2010. But they just raised $30 billion to buy homes with, and I don't think they're buying them one at a time. I think they're looking to scoop homes up on these entities like Door, sticking their entire leg into the water right now to see if it makes sense for them to sell these homes individually or not. They're taking major haircuts. They're taking absolute baths on these properties that they overpaid for, and they're now trying to sell in a weak market. Really, really stupid move. But some of these big entities, when you're not spending your own money, when you're spending someone else's money, it's much easier to take a risk. And a lot of these CEOs, keep in mind, like essentially it's a free roll for them. Paid huge money, CEO, right? They have stock options in the company, but if they don't grow the company, they'll get let go. So they have this sort of free roll where it's like, okay, well, let me just take a ton of risk and hope it works. And if it doesn't, I'll take my parachute package and I'll exit this way with a little bit of money. And if it does, then I'll be the king of the world and I'll get hired somewhere else and they'll fight for me and I'll get paid tons and tons of money. So it's like this free roll. And that's why you see a lot of these big companies making bad decisions, but there's definitely still a tremendous undertone of demand for real estate. And this is actually Patrick Carroll is the founder and CEO of Carroll, is what it's called, a real estate investment firm, talking about rent growth. They are huge in multifamily. That's what they believe in, and they're probably going to be right about that. When was the last time you really saw rents decrease? It's been a long time, maybe 20 years ago, something like that, where we actually could say, rents have been going down. And that was fueled by all the stuff that led up to the crash. And I've gone over that a million times, but that was part of it. And that whole shenanigan is pretty much impossible to repeat. Pretty much impossible because of forbearance. We're in a housing recession, experts say. See what this means for homeowners, sellers, and buyers. I thought this was interesting enough because there's some things that you can look into here that really do make sense. So sales of existing homes down 20%, 4.8 million properties versus 6 million last year. So number of sales, volume, that pie I was talking about, the shrinking, that's what you're seeing there. Median price, though, still up almost 11% year over year. And then they put a couple pieces of decent advice in here that I thought would be worth at least looking at. And you can hear from Lauren Young, who's the chief economist for National Association of Realtors, and he gives his 2 cents throughout this article, and it is pretty good. It is pretty good. He said, it's not a recession in home prices. Inventory remains tight and prices continue to rise nationally, with nearly 40% of homes still commanding the full list price. And he's right. Hey, 40% getting full list, that's still pretty strong. Like, that's not weak. It's not we're on fire. It's not, hey, expect double-digit returns, but it does show that there's still a lot of demand overall. And that's nationally. In San Diego, I expect it to be even better. Homeowners are in a very comfortable position. He goes on to discuss that, the data behind that, how well homeowners are doing with equity positioning and so forth. Buyers may encounter a more balanced market. This is also true. Should expect a little bit better price negotiation possibility. He said last year, mercy of whatever sellers were asking. There were multiple offers. Buyers now may not face that now. And that's true. So he gets that right. A little bit more detail on that too, if you want to check that out. And then this is what's funny. And I wanted to screenshot this. And this is, if you're a realtor, you're going to want to copy this link for all of your listing appointments. Here's what Young said about the new market. To be realistic, what I'm seeing is sellers not caring that much. I'm not seeing a ton of really motivated sellers. The sellers who are really motivated, who are sort of stuck and have to sell because they're in contract on something else, or already moved and they're two mortgages, or whatever. Those are the ones buyers really deals. They're few and far between. There really aren't a ton of them. Most sellers are kind of like, yeah, if I can't sell it for this, then we won't sell. We won't do it because we were going to use the proceeds to buy the next home, or we wanted to get that much because it would allow us to do this and this and this. And if we can't get that much for it, then we won't do it. And we're already heading into a time of year where seasonally you're going to see inventory decline. I think it might be exacerbated this year because of the exacerbated increase. So we'll see what inventory looks like in December, but expect it to be less than now. This is probably as good as it's going to get inventory wise this year. But if you're a realtor, you need to screenshot this. Sellers need to be realistic about the changing market. Yun said they cannot expect simply list their home at high price and easily find a buyer. Many buyers chasing after too few properties. Those days are over, he said. So if you're sitting down for listing appointment, this is probably something that you're going to want to show the seller, right? For my realtor friends, I wanted you to see this and send the link to your sellers and so forth. But that's it. That's all. All right. Thanks everybody for saying up. C Green, Savage Juan, Michael C, Nathan T, Greg S. What's going on, guys? I appreciate y'all. But long story short, let's revisit. I'll recap here at the end. We have lost support for mortgage bonds in our upward channel. We're now trying to find where is the bottom. We had an indecision candle today, which could be good. Could be good. Doesn't have to be, though. Does not have to. You know what? I could probably show you that, huh? I talked about it earlier. I will show you that. That's how we'll finish today. So we're trying to see what's happening, but we do have support. There is support here. And so we're hoping that that will hold. I would like to see a nice move back up here. If not into the channel, at least back up to this resistance area. We'd like to see that move at least. That puts us in a range. Because if we go there, then we can say, okay, well, we're just ranging from here to the bottom of it, to the top of it, back to the bottom of it, and then back to the top of it. That would be okay. We want to be sideways. We don't want this to be the beginning of a new downtrend. If you're a bear, you look at this, you go, oh, look, Derrick, you're not drawing the negative channel. You've got so many lines on here. My goodness. You're not drawing the negative channel. You're not drawing the downtrend. You're so biased. Why are you so biased? Everyone says that to me these days. It's hilarious. I've been more bearish than any of you have ever been. I called the crash in 08, in 07. I sold my house. I got out of the business. That's how serious it was, and I knew it. Okay. There's your downward. Happy bears. Now, there is support here, so let's see if it holds. We turn thing around pretty easy, but as of right now, this is we're definitely in a position where we want to be locking every day immediately. We pulled rates earlier. What did we find? We found FHA VA 4.5 to 4.875%. This is detached home, 780 credit, no points, no lender fees. 0.5 to 4.85. Conventional loans, 5.375 to 5.99%. Okay, that's the difference between conforming and high balance. The threshold there is 47,200. So this again, detached home, 780 credit, no points, no lender fees. Jumbo found this gem here on the 7/6 arm action, 4.575, and we got on the fixed was 5.125. So that was not too bad at all for fixed on jumbo. So jumbo rates are really good. They continue to be better than high balance conventional rates, and that is just a mind boggler for me. It sort of reiterates to me that these bonds here are oversold. Have to be. Listen, this is government backed paper, guys. The jumbo paper is not backed by, except for the property. The government paper is backed by a property and the government. You can sell it to the government. They'll take it. Or you can keep it yourself, service it, and then sell it to them later if you have to. It makes no sense why rates for conventional loans would be higher than jumbo loans. It just doesn't. Except for maybe you could say the jumbo market, secondary market, is not as manipulated. Gets that. Okay, let me show you this one more thing here. I'm going to pull it. I want to show you what happened. So a lot of people were asking me like, hey, what's going on? Is the market, in the stock market specifically, is the stock market crashing? Like, why, how are we so positive? How do we have such a run up and then now we have such a run down? Like, what is up with that? Well, let me just pull this over here. I'm on another screen. We had what I call the middle finger candle. Middle finger candle is, well, you'll see it. In the name of it, it tells you everything you need to know. So that's a daily chart. Now let's go. We're looking at the Dow Jones here. I saw this on Friday and I wanted to make a video Friday and I just couldn't get to it. I just couldn't. But what I was going to tell you on Friday was we got a middle finger candle. It's just not a pretty sight. So this takes a second for me to get this where you can really see it. Okay. All right. See this guy right here? I'm going to show you something. I'm going to teach something. Look at this. This candle right here. I call it a middle finger candle. There's a better name for it, I'm sure. But whenever you see that candle, it pretty much means you're going to see lower prices. Okay? Like you're almost guaranteed that you're going to see lower prices. And you can see every time we've had one like this, whether it's this one here, there's others back here as well. Pretty much every time you see the market produce one of these candles, we go much, much lower. And the opposite is true. When you see it from the underside, we typically go much higher. But the other thing that made this especially bearish, and the reason why I was very bearish on stocks to start the week, which has worked a bit for me, is because we see this one up here. This is one too. That's a middle finger candle right there. That was the top. And these are weekly candles. So we have the trend line here that we were trying to break last week. We had gotten out of the downward trend and we were looking really, really good. And then it just fell apart towards the end of the week and closed like that on Friday. So my video on Friday would have been like, look out below for the stock market. You know, we're going to see a retreat here, and it may not be pretty, guys. So I'll just tell you, I'll give you my realistic prediction here for everyone who says that I'm so positive. I'm such a perma bull. I would never say anything bad about anything. To tell you that right here, right now, we're definitely. Oops, I do that wrong. Sorry. It's important to draw it right if you're going to rely on technicals. This is a bullish move. And look, we're up a lot in recent history here. So this kind of pullback is totally reasonable. But I think we're headed back to at least here, 30, let's call it 32,000 in the Dow. And that's another 1,000 points from where we are, and quite possibly 31,000, low 31,000 in the future. This golden pocket right here, 31,300, we could be headed there. So if you have, gotten out of stocks, or if you've scaled out, if you're not dollar cost averaging in, you could see this could be a really good time to get started putting some money in as this, pulls back further. I really don't see any possible way that we see like a huge turnaround here. There's just too much overhead resistance. Middle finger candle is It's powerful. It tells a very, very, very big story. Bulls were unable to win over the macro trend here in the Dow, which is down. So that's what that's about. So there's some bonus coverage for you. All right. Hopefully that's fun for you guys. I appreciate your time. Listen, let's do this before we bolt out. We'll leave you with some music. Why not? Just remember, don't have to pay these crazy fees to get a home loan. You don't have to pay these crazy high rates. Quick shout out to all the mortgage bankers out there. Thank you for making it easier for me. You just stay in your comfy chairs there in your nice offices. I will work from home and hook my clients up. Reach out, email, text, call me, and I will hook you up. Have a great day, guys. Take care.